Hello, Hugo. Thank you for having you here. It's a pleasure to speak with you again. How are you today? And as most of all, how's the weather in Amsterdam? Because I think that we are sharing the same rainy rainy environment here in Europe.
Yeah, thanks for having me, Michelle. Great to catch up together. Yeah, for sure. Autumn has come also in Amsterdam. So it's rainy, it's windy, it's gray. So an ideal timing to sit inside and talk about fintech and everything associated with that.
Yeah, it's always a pleasure. Do you want to give us a short introduction of Motive? I know that you guys are working hard in the fintech ecosystem right now, but I would love to have a brief explanation of what you are doing right now.
Yeah, sure. So Motive Partners, we are a stage agnostic fintech investor. We have a private equity growth equity strategy, and we have a venture strategy up and running. And we actively invest out of a 220 early stage venture fund, seed, Series A, Europe, US. So that's what the venture strategy is about. Motive platform, we focus on operational value add. So we have the IOI model, how we call it, invest, operate, innovate. Well, investors, that's clear, that's us. Operate a strong and deep network, financial services, industry partners, and innovate. We have Motive Create, our own value creation unit, fully focused on tech and driving value for our portfolio companies.
So you're, let's say, you're also trying to have a little bit of value in the startup that you're investing to. I wouldn't call it maybe a private equity approach, but let's say a more active approach than usual investors.
Yeah, I think it's very important, let's say, for startups, what do investors add on top of the money?
Mhm.
I think, let's say, money or was particularly, let's say, in 2020 and 21 was really a commodity, but still
Yeah.
uh, is what do investors add to your company? Is it sector knowledge? Is it distribution? Is it regulatory setup? Is it internationalization? Is it tech? So, what do investors add beyond, let's say, being debt capital? And we hope to add more with our sector knowledge, with the operating partners to these to our investment companies.
Yeah. You said something very interesting. So in 2020, capital was really a commodity because basically with interest rate that low or even negative, basically everyone was able to get capital. But after 2022, let's say the situation changed a lot. And capital is not that present anymore, or at least it's a little bit harder to get an investment. So one of the questions that I'm usually asking a lot to VCs recently is, okay, how hard it is right now to actually get an investment from a VC fund, but at the same time, how hard it is to actually raise a new fund right now, because the environment right now is pretty complex. Competition is crazy high. Interest rates are very, very high, even if they are going to, let's say, be lowering down a little bit. But how hard it is the environment right now?
I think in the end, it's definitely tougher than it was in 2020, 21 for VC funds ourselves and for companies to raise capital. From my perspective, I think it's for the better. So a lot of companies were funded that didn't per se have a right to exist. And to be honest, same goes maybe also for VC funds. Let's wait and see, because a lot of capital has been raised. In the end, for us as investors, it's about the financial return. And more so, let's say all the returns on paper, that's great, but it's about liquidity. And that's
Yeah.
where the ecosystem now is a bit stuck.
Mhm.
There's less liquidity. That means that LPs have less capital to deploy in new funds or funds raising. And that, well, exit climate is challenging. IPO window more or less closed. M&A market is a bit more sober than it used to be. Yeah, so it's challenging times. On the other hand, if your financial return profile is healthy, there should be a way for you as a startup, but also as a VC fund to raise the capital that you want and need.
Mhm.
As long as your offering is very, very clear.
Yeah.
VCs are in the servicing business. So as long as our product, the value add, the return is healthy, then I think people should be able to raise money.
Yeah, so a very interesting point that you just mentioned is M&A. To be honest, after 2021 and 2022, I was expecting a wider wave of M&A operations. Indeed, I think that we saw some of them, but not as many as I was thinking in the beginning. So I was expecting a wave of aggregation, mostly in the fintech market, to be honest. You were expecting the same, or you were expecting something different after, the downturn and everything else?
I think people are still a bit in waiting mode.
Mm.
And I think the companies that raised a lot of money in 2020, 21, and that have really strong balance sheets, maybe the valuation was a bit on the higher end. But if they raise sufficient capital, well, they have time and people have lowered their burn. So let's say the good companies that raised a lot are still in a relatively okay position. And hopefully they grow slowly but gradually in the valuation that makes a bit more sense in the current environment. Companies that are not performing well, that are running out of cash, and maybe there has been an extension by current investors, another extension, but that are not able to go to the market to raise new capital. I think buyers are still like, okay, let's wait and see how it
Let's
plays out.
evaluate.
There's not
Yeah.
an absolute need for buyers to buy companies that are not performing very well. And if these companies are relatively small and are still burning cash, then for a buyer, if you buy a very small company, why take all the hassles, the tech integration? What's the value creation plan for the larger buyers in the end? And yes, we've seen consolidation within the fintech ecosystem itself, but there's much more to come.
Yeah. No,
But
I
it will take
strongly,
time.
strongly agree. Mostly because I was expecting, let's say, more activity in the private equity direction, because I strongly believe that there are many opportunities on the table right now, mostly in Europe in terms of fintechs, because there are good businesses out there that were running purely on the, let's say, assumption of a next funding round, okay? And they could be very good target for private equity because they can actually enter, restructure a little bit, and take what is good about the business and try to push it as a good company, but I strongly believe, let's say, I strongly agree with you. I think that there are a lot of people waiting for the right opportunity out there at the moment, because there will be opportunity anyway. Sooner or later, some companies will not be able to afford a new bridge round or a new funding round, and there will be opportunities in the market.
Yeah, and of course there has been a lot of conversation about, let's say, the 21 fundraisings, and then you raise capital for 24 months
Yeah.
or maybe 36, and everybody was speaking like a flood of new startups coming to the market that need additional capital. And maybe it's coming next year, who knows? But I also see that slowly but gradually things are being absorbed by the market with the bridge round, path towards
Yeah.
profitability. Those are metrics that in 21 nobody was speaking about, a
Yeah.
path towards profitability or actual profitable companies. But for PE buyers, it goes more or less the same. So if companies are bleeding cash, that those are not the interesting PE targets.
Yeah, no, I strongly agree. I mean, in 2020 and 2021, the only metric was growth, and no one was, caring about anything else.
No,
And yeah, that is something that couldn't last, forever.
no.
But I think it's a good point. I mean, in that direction, I think that only the right companies survived after that period, and a lot of startups died, as it is normal.
Yep.
But we are seeing a lot of shift in the market. Like, for example, in the open banking sector, we are seeing a lot of shift from the concept of open banking to a more open finance and embedded finance concept. And I think that the same kind of transition we are seeing in many different kind of in markets and verticals, like payments and open banking, but also digital banking. One of the concepts that I'm most curious about is something that is called a financial super app in Europe. Something like what Revolut is trying to build, something like what WeChat built in China, for example, in Asia. And I'm very, very curious. Do you think that something like a financial super app is actually possible in Europe with the European consumer and with the European corporates?
I think Revolut is showing that it is possible to create a massive company with the concept of a financial super app for retail,
Mm-hmm.
but also on the SME side. And for instance, you also see Conto
Yeah,
that acquired one of our portfolio companies, Penta. That you see, let's say, on the SME side
yeah,
of things, that it is possible to create a massive success story and a potential IPO story out of these companies being the financial super app, whether it's for retail or more on the business side of things. So yes, the market is there, the opportunity is there. Is there room for 5 super apps? Well, most likely not. But
Probably
let's say
not.
Bank out of the Netherlands, also on the retail side,
Yeah.
Starling, Monzo. So and it's interesting in the current environment. Let's say, what are you within fintech? Are you focused on tech or are you focused on fin? And a lot of people, let's say in 21, focused only on, let's say, tech, but the whole
Yeah.
fin, financial services. Are you a bank or are you a tech company? That is a super interesting question. You see now these companies that are maybe more or less a bank gaining a lot of, let's say, revenue traction based on interest yield.
Yeah. Yeah, but
Yeah.
I think that we are shifting a little bit, as you said, from the strictly product and tech side of those kind of companies to a more financial services concept, because like, for example, in 2018 or 2020, it was very, very easy to build a digital bank. You could easily do that with a third party developer agency, a banking as a service, and you actually have a digital bank. Very easy to get one. But actually scaling that and having a real properly financial services company is way, way harder. And we are seeing that right now. Only a matter of, of the companies that were active in 2020 are now still alive. And that's a very good point, to be honest.
Yeah. No, fully agree.
Yeah. Talking a little bit more about the environment itself. I know that you have been to the Nordic FinTech Week last week. There were also the Italian Tech Week in Italy. There will be FinTech Summit next week in Italy again. There are bits and press and other very good events in Europe right now. Do you think that the European ecosystem is growing, is being a little bit more mature? I wouldn't say on the same level of the US, that is of course far in terms of investment and in terms of success. But do you see any progress there?
Yeah, I see a lot of progress in Europe. We were far behind. Slowly but gradually, we're catching up. I think an important thing is here that you see now second and third generation founders. So people that started a company maybe 10, maybe 15 years ago, sold that company, or maybe it was not so successful, but you learn from the successes, but also from the failures. And those founders coming back to the market with capital, with experience, with network, with learnings. And that creates a very vibrant startup ecosystem. And let's say those founders that have the experience and that really are solving a problem instead of, hey, this is a great marketing gimmick and I raise money and off we go, but are really solving a tangible problem in financial services or embedded, but let's say in that space, the quality of the founders is pretty good. And let's say those founders don't have a lot of challenges raising sufficient capital. Let's say the second time or the third time founders, but also the inflow of capital out of the US. If there's a real problem that people are solving, they will find a way also to get funded.
Yeah. Coming into that direction, something that I noticed recently, for example, there were 5 investment managers from Sequoia attending, for example, the Italian Tech Week last year. And I was remembering the first time that I attended that event 3 or 4 years ago, there were basically 0 investors from the US. So that is a huge step forward, in my opinion, in that direction. But it's also making me questioning. Do you see the real difference there between the US ecosystem and the European ecosystem? Of course, there is a huge difference, but I would like to hear your thoughts about, being an investor in the two market at the same time. How are you actually, thinking about European startup and US-based startups? How are you actually making that kind of distinction? Do you act differently, for example, when investing in the US and when investing in Europe?
No, we don't act differently, but the markets are very different. So the US is much more 80% of the market across different states is more or less same. In Europe, it's, let's say, 20% is same due to the regulatory setup that we have chosen. So from an internationalization perspective and how do you scale as a fintech within the regulatory setup, there's a big difference. And I think in general, risk appetite, for instance, in Europe, pension funds, institutional capital, the risk appetite for VC, and also the awareness that this is a long-term game. This is not a PE game, 3 to 5 years, and then a value creation and on to the next one. Venture is a long-term game. So 5 years really on the short end. I think typically no way. So it's much more 7, 10, maybe even longer to really build out sustainable companies. And in general, the risk appetite in the US is bigger than compared to Europe. I think there's also the difference in valuations. So I would say in general, valuations in the US are a bit higher compared to Europe. And there's more capital there. Let's say also from a VC perspective, you see now also third, fourth generation of VC funds coming into Europe and into play and driving value for the ecosystem here. US has a much longer history there, and that's perfectly fine. But we're catching up, and that's a good thing.
Yeah, I think they're more mature in terms of, let's say, timing, because we are maybe coming out of the first generation, going to the second or maybe third. Maybe they are way above the third and fourth generation in terms of founders, at least for startups and those new services, let's say.
Yeah, no, absolutely. But also here, let's say liquidity is key. So let's say investors need to sell the companies, that money needs to flow back to the ecosystem, institutional capital needs to be recycled. So that whole flying wheel definitely also needs some acceleration. And let's say the exit climate also here, Europe compared to the US, it's very different.
Yeah, I mean, the exit side is always, the real problem behind this kind of market, because it's an illiquidity market. It's an illiquidity investment, sorry. And there is something that is very, very complex to explain, for example, to a European investor compared, for example, to the US, that maybe are a little bit more financially educated under that point of view. But I agree on one point, we are catching up quite fast, to be honest, under a certain point of view, and we are seeing the progress made every day. I would love to understand a little bit more. How do you evaluate those investment as motive? How do you choose if a founder, if a startup is a good investment, or do you think is a good investment?
I think given the fact that we invest early, seed, Series A, and also occasionally pre-seed, it all comes down to the founder. So let's say if you're more on the growth stage side of things, then there are metrics, there are numbers, there is revenue. For us, the main value driver, the main decision criteria is founders. And we try to be as considerate as possible in that. Let's say instead of only trusting on your gut feel to really more and more institutionalized founder assessment, but it comes down to drive, it comes down to experience, it comes down to personality. And it's not only the single founder, it's about the founding team. How do they cooperate together? What has been their history of solving problems? How do you handle situations when things don't go according to plan? So and in the end, time is the best due diligence. Getting to know each other is crucial. And we went from a time during COVID that everybody was making investments remotely and I still remember, let's say the day that COVID hit, before COVID, I always flew out to meet people in person before I made an investment, and that suddenly came to a halt. And then I thought, I'm never able to make an investment. And guess what? 4 weeks later, everybody was behind Zoom and wiring money for new investments like that was pretty normal. And now you see, hey, if you are able to have the opportunity to meet people in person, go for dinner, get to know each other, talk broader, instead of only about the company. What makes people tick? And it's that whole spectrum of a personal relationship that is super important, and that takes time. Sometimes, if the deal is competitive, there's less time. And founders should do the same on us. Make reference calls on let's say the people that you're speaking to. How do we act in case when things don't go according to plan? What's our personal track record, etc. It's a long-term relationship, as discussed earlier, Michel. 5, 10 years plus. Do your homework to the extent possible, and it's a two-way street here.
Yeah, I always believe that founders usually think about this kind of investment as a one shot. You get the money or you don't get it. But usually it's a long-term relationship because those people will stay with you. They are on your cap table. They are behind you when you take a decision. You need to inform and update them every time. So you need to build a relationship with them. Otherwise, you're going to have a problem, or at least you're going to have an hard time, having them on your cap table for a long time. So I strongly believe that the physical presence, or at least the physical encounter with those people, is going to be a key for the long-term relationship. Maybe how hard it was to invest remotely during that period, because I think that if you're focusing that much on the team, as everyone is doing, and having that kind of relationship during the COVID time was very, very hard for you to get to do those kind of things.
Yeah, it was hard and to be honest, also uncomfortable at
Yeah,
first. But also, let's say we also found out that it was possible to make investments and also
yeah,
good investments and sometimes not so good investments. That's fine. So we thought it wasn't possible. It was, but now that let's say travel is much more open, I, I really prefer let's say those personal
mhm,
interactions.
yeah. No, I agree about that one. Maybe shifting a little bit the argument, I was, curious about your take on a current couple of trends. So we have been talking about the shift that has been happening right now in the fintech market, going from the concept of digital bank to the financial super app, or from open banking to embedded finance and open finance. But there is a huge trend that is going on right now, that of course is AI and the impact of that kind of innovation in the market broadly and widely in every different kind of markets and verticals. So I was curious about your take on this new technology. Do you think that AI is an habilitator of new businesses, that is something that is providing value, or that is something that is maybe too much disruptive? Because I heard very different feeling about it in the market, apart from the obvious bubble that is that is kind of growing up in the space.
No, I think Michelle, let's say AI will have a massive impact on society as a whole. It's also on financial services and also on tech companies. So it's a trend we discussed with all our portfolio companies, with all our new investment companies. What is your view? What is your perspective? How do you apply it? We see large banks moving. How fast are people able to move? Do you work together with a startup that has the latest and greatest AI applied? But if it's not explainable to the regulator, how easy is it then for a large institution to adopt like every new technology, to be honest? Um, for us, we think in a couple of years' time that nobody will speak about AI. It's just embedded in tech development, go to market, everything. It will be fully incorporated in everything that we do. So also for our startups, and where we now focus more is really deep vertical AI. So let's say less focused on the horizontal side of things.
Mm.
If you develop a general co-pilot, there are quite a few of those around. Not to say, those can be valuable and those can be interesting companies, but it's pretty crowded there. So the more vertical domain knowledge people have within AI, the better it is. So for instance, we invested in a company named AlphaStream, AI specifically focused on private credit, 6, 7 years around, with a deep vertical knowledge on let's say the private credit vertical within financial services.
No,
That's what we like, and that's where we focus on right now.
so more let's say a vertical approach than a horizontal one. So
Yep.
one of the conversation that I had recently about this kind of topics is that let's call it a gut feeling. So my personal perception is that huge corporation, for example, banks, are strongly pushing and focusing on the cost reduction side using AI. Very, very easy example. You got customer support. You can get rid of total first level of customer support implementing an AI bot. That's very, very easy. It's a cost reduction thing. At the same opposite side, you got startups that are trying also to go in the opposite direction. So they are able to get more revenue using AI, or at least expanding to different kind of industry markets and vertical using AI. So I was curious. I was wondering, do you think it's more the first one or the second? Do you think it's a kind of a technology that is helping you reducing cost and being more efficient, or it's something that is helping you out to expand very widely in different direction?
I think it can be both for sure. So let's say the cost reduction side is maybe a bit easier because those solutions are out there. And if banks work together with the large tech vendors, whether it's Google, Microsoft, or Amazon, let's say there's quite a lot of, let's say, that optionality already available. But a lot of talk has been in the past about personalization, whether it's on the retail side, whether it's on the wealth management side, with AI and making it really tangible. Real personalization is now possible. Really create a personalized investment portfolio, create a personalized newsletter. Really, and that should drive engagement, and engagement should drive revenue going forward. And that will be possible with AI. And you can also see, hey, maybe personalized loans. I think we're a couple of steps away before the regulator would say, okay, great, here's a black box, and it's called an LLM, and that is a self-driving lending module, and the AI will decide yes or no on providing credit. We're not there yet, and I don't think that we will get there at all because there needs to be
I
some
don't think that we are very
explainability.
far away from that point, to be honest.
Yeah. So let's say that is on let's say gaining revenue from lending takes time, but let's see the personalization side of things for sure. And also, if you look at let's say fraud, compliance, the whole regulatory space, you can see that as cost reduction. But here, let's say real-time monitoring that is now possible with AI going forward, and that's a significant cost reduction maybe for banks, but from a society perspective, that's efficiency. If you see how many people are now involved and how much resources are being wasted on the whole fin crime thing, conceptually with automation and now with AI, automation on steroids, a lot more should be possible there.
Good point that you mentioned. I think there will be a huge habilitator of this market is the regulation behind it. So right now, for example, in the US, there is California that is trying to pass a bill about AI and how to use those kind of tools. The European Union is talking about it, but there is still no specific regulation about on how to use AI and how that kind of innovation should be regulated. So what do you think the regulator should do in this case? Because I think that this will be a huge let's say a huge step in that direction, the direction of adopting AI. Do you think we need more regulation about it, or do you think we need a more free market? Let's call it that.
It's a good. I think maybe Europe is very good in sometimes over-regulation.
Yeah, we are the champion of it.
Yeah, so no, that's also a championship that we win.
Yeah,
right.
Yeah.
So over-regulation is not per se the best way going forward. On the other hand, a full free market on AI and just letting it ride without any guarding rails, that feels
Maybe
also challenging for me. So I would say for this one, let's meet somewhere in the middle, but an open mindset towards AI, and let's say it's out there, and we will never contain it back and say, okay, let's go back to the world where AI wasn't there. That will never happen. So we need to accept it and provide the right guidance, and not say, no, it's going to destroy humanity, because it's out there. It will change us and it will impact us, and how big, well, let's wait and see, but most likely the impact will be huge, and maybe it will take longer than we now expect. But as a regulator, you need to have a proactive approach on it, and at least it should be top of mind how to act on that.
Yeah, I think that proactive approach could potentially be helpful, because usually we tend to react very, very slowly to those kind of things. And I don't think that this is going to be one of those technologies where we can wait and see what is happening. We should have a very proactive approach, because it's going to impact, it's already impacting a lot of lives. Let's take a look, for example, at what is happening at Klarna with the cost reduction related to the workforce, or many other kind of implication, for example, also in the US with the upcoming election that is coming. But yeah, it is a very current topic that is impacting everyday's life. Yeah, maybe last question that I wanted to ask you: what is a trend that you are following very closely that maybe is not that common in the market, or at least that is not on everyone's mouth?
Within fintech, you mean, Michelle?
Very widely. I would love about fintech, but also in general, I would love to see something that I didn't saw in the market yet.
I think within fintech, we spend a lot of time everything around wealth, and that is driven by the more macro environment. Let's say the people get older. Let's say the maturity of the population and the big transfer of wealth from the elder generation to the next one. We're in the midst of the biggest wealth transformation ever. So
Yeah.
that is a topic where we see whether it's in alternative investments, whether it's in private banking, whether it's wealth management or on the equity side of things, a lot of innovation happening. So that's definitely a core focus point for us. And I think also the embedded finance thing, but then really also again sector specific. So for instance, a portfolio company of ours, Nelly, embedded finance within healthcare. Those are, let's say, trends that, let's say, fintech is very young. It's only, let's say, 10, 15 years old. And we used to call it technology for financial services. But still, let's say the financial services industry is one of the biggest industries out there. So for us, sometimes people are a bit, let's say, negative on fintech and hey, we've had a great ride. Is it going to be here in 5 years' time? It's boring. Well, we think, let's say, we're only in early days right now. So for us, we're pretty positive and bullish on, let's say, fintech going forward.
Yeah, no, I strongly agree. I think that we are still not mature as a market, to be honest, in
Yep.
terms of fintech. So as you said, it has been born, let's say 10, 15 years ago, at max, in terms of, a real market, in terms of real offering and products and everything. And we are seeing right now the kind of outcome and the kind of impact that has on final users' life in terms of having, for example, a bank account in a bank that is not physical, or having a loan that is completely approved online without any human looking at it. So it is something that is developing right now. And as every kind of technology, as every kind of market it has an impact. It has a bad period and all the kind of downturn that we faced. It's something, in my opinion, that is normal and in certain kind of way also, let's say, positive, because it gets rid of everything that was not healthy for the environment, that was fraudulent potentially, everything that is not built properly. And right now we have good companies that are doing things right and properly in the market.
Yeah, yeah. You see that, for instance, with crypto and the whole digital asset space. Well, there was a lot of hype that went down, and let's say in the traditional hype cycle, there will be parts of, let's say, those waves that will have a sustainable use in society, whether it's stable coins, whether it's tokenization. Well, let's wait and see. But those innovations are boiling somewhere
Yeah.
or let's say a bit below the surface. But things are happening there for sure.
Yeah. Oh, yeah, that's a good one. Let's say there are a lot of funds out there that are not touching crypto at all, let's say. So what's your take on that market? Do you like that kind of innovation, or do you prefer to stay a little bit far away from it?
I think typically we are much more intrigued by the B2B side versus the B2C side. So if it comes to direct crypto trading, not per se for us. If it comes to the underlying tech and the infrastructure, that is something that we spend time for sure.
Yeah, for example, I
But
think
also
that,
here, let's
yeah,
say now with MiCA, or let's say the regulation that's
yeah,
coming up in Europe, that provides a much clearer way how these companies can grow as well. There
yeah.
were so many question marks, and now slowly but gradually it becomes much more clear how these companies can operate, and that should drive innovation, and that will drive more investments in that vertical.
Yeah, yeah. MiCA is going to be a huge game changer in the market because it push companies and corporates to be real businesses and not just a small startup making a little bit of a little bit of tokens and let's see what happens. No, they need
Yeah,
to have compliance in place. They need to have AML in place. They need to have a lot of things, and they need to scale up a lot and very, very quickly because it's coming in 2025. So it's going to be a huge game changer. But yeah. Let's say I really like that market mostly because of the use cases that are way, let's say, more often behind the scenes. Like, for example, it's very easy to implement a cross-border payment for corporates using the blockchain and using the crypto infrastructure that you have right now out there. But people are not focusing on that. They're focusing on different kind of things. But also this is possible, and it's going to be a huge impact, mostly in region like, for example, European Union, or for example the MENA region, that are always interacting between each other with so much time, long time to take cash in, for example.
Yeah, absolutely.
Yeah, Hugo, it was a pleasure to have you here. It was a very, very interesting conversation, and yeah, I would love to have you again next time. So thank you again for joining, and it was a pleasure again.
It was a real pleasure, Michelle, and good luck with the gray weather outside for you as well.
Yeah,
Hang
let's
in
hope for
there.
the sun.
Cool.
Thank you.
Thank you very much.
Bye.
Speak soon. Bye.